Welcome to ForexTV.com. It's Friday, January 11th. I'm Remy Hickey with your New York Forex Market Buzz. In New York afternoon trade, euro dollar is at 1.4795 as of 1:10 p.m. Eastern Time. Sterling dollar is at 1.9574, while dollar yen is around 108.95. In today's data releases, the U.S. trade deficit widened in November by 9.3% to $63.1 billion. The imbalance came in larger than expected due to the surge in oil prices. Meanwhile, export prices rose 0.4% in December with a year-on-year rate at 6%. And December import prices were flat. Ex-petroleum import prices were up 0.3%, with the figure up 10.9% over last year. Joining me this afternoon is Greg Michalowski, Vice President of Trading and Liquidity at FXDD. Good afternoon, Greg.
Good afternoon, Remy.
Thanks for joining us today.
It's always my pleasure.
Well, Greg, with the market already pricing in Fed rate cuts and the BOE and ECB out of the way, we're seeing equities in the red today and gold topping $900. So if you could tell us how today's volatility in the market is playing out in the yen crosses, starting out with sterling yen.
Right. The sterling yen is a interesting pair. It's obviously been under pressure as the really the sterling and the dollar yen has both come down. On a longer-term weekly chart going back to 2000, the year 2000, there's a lot of support levels that came in at the levels at the lows that we've hit this morning. In particular, there's a 200-day moving average, a 38.2% retracement, and this is from the move going back to the year 2000 to the recent highs that happened at the last year. So the low today in sterling yen got into the 211.90 area. That's close enough given those key support levels came in around the 211.77 area. There's also a trend line from that same period that comes in at 213.65, and if you, I think I sent you a chart that has a closer picture of all these support levels. So we were just able to squeeze above that level, getting up near the 214 level around the London close today, but since then the stock market's gone down, sterling yen's gone down, and it looks like we're going to be closing below the 213.65 trend line, which is held since the year 2000. So that's a big deal in something like this sterling yen. The good news is that we bounced off the 200-week moving average, and if you go back to the longer-term chart that shows the picture going all the way back to the year 2000. There are at least five levels where the price action tested the blue line, which is the 200-week moving average. And so unless we, until that point when we break the 211.77 area level, you got to think that perhaps sterling yen might be near a bottom, but still the medium-term trend is probably down. So be careful with that pair, but keep those levels in mind, and if it breaks, don't get in the way.
Well, while we're on the topic of sterling, if we could take a look at euro sterling, which continues to hit record highs. From a fundamental and technical perspective, and also taking into account the pair being overextended, if you could give us your forecast for the pair, and if you could also tell us whether the same fundamentals are reflected for the euro and sterling versus the other majors.
Sure. Well, I think you have a picture also of the euro sterling daily chart going back a ways, and certainly the trend in the euro sterling is up, and that's reflective in the policy that the two central banks are both running. Clearly, yesterday we had the announcements from both of the central banks as an unchanged policy. The sterling or the UK Bank of England doesn't give out any of their, they don't have any meeting highlights or press conference That won't come until the 23rd of January. But the ECB, Trichet and Weber were both on the wires yesterday speaking about their fears of inflation. And what is also a common theme from them is the secondary effects of inflation that they see as a threat as the price of oil and food go up. They see inflation creeping into other areas of their economy, or the potential of it. So the ECB is going to remain tight with their monetary policy and concerned about inflation. The UK, on the other hand, they did ease once. The expectations are they will probably ease in February, as we do see weakness in their retail sales. One of the big retailers, Marks and Spencer, came out this week urging them to cut their rates, as they don't see any bounce in retail or any strength in the retail sector. And also housing is an issue in that economy, and the financial sector is an important driver in that economy as well, and that we know the risks of that. So I would expect the euro to remain relatively bid against the pound sterling, and the sterling to remain, offered, although it's probably reached, maybe at a point where it'll slow down its decline. We did come down from the sterling dollar came down from 211. We're now trading comfortably below 200. So it has made a move, but against the euro, we're still at high levels. And the euro, the only way the euro sterling, we need to have some closes, maybe one, maybe two closes below the previous day to kind of take the pressure off the upside. It is an overbought situation, but it's been overbought for a while, and certainly, as I suggested, the fundamentals suggest that the ECB is going to maintain a tighter monetary policy, while in the UK they're more concerned about growth, and they'll probably be focused more on an easing cycle down the road.
Okay, and last but not least, Greg, if we could take a look at the Aussie dollar against the U.S. currency. We already touched on the commodity currency, so if you could highlight the technicals that you expect will play out in the pair.
Sure. Well, the Aussie dollar is a commodity currency, and they've been enjoying a strong economy over there as a result of their proximity to China in particular, and the need for commodities from that country. So on Friday of a week ago, the pair closed below a key 100-day moving average in that pair, and it looked like, well, perhaps maybe if it opens up Monday lower and gets a head of steam on the downside from a technical perspective, it might be time for continued downside pressure on that pair. But as the week went on, they had some strong economic data come out of the country in retail sales and such, and it forced the pair up to where it looks fairly well supported, and the expectations are probably going to be that the Aussie in Australia, they're probably tightening their credit conditions rather than looking to ease them, as most of the other sections of the world are doing. Dollar Canada, the pair, the Canada actually has been having some wheat data come out of their country, and that has propelled that commodity currency to the dollar to go up and the Canada actually go down. So it's kind of in contrast with the Aussie, which is unusual, but where the Australian economy is seeing strong growth, whereas the Canadian economy is starting to see some weak growth. With they had their employment number come out today, which was much weaker than expected. So they're kind of being influenced more by the U.S. Side, and the Australians are being more influenced by the Chinese, and clearly those economies are diverging, I guess.
Okay, Greg, as always, thank you very much for your insight and analysis.
My pleasure. Have a great weekend and a great week next week.
You too. Thank you very much.
All right, bye.
That wraps it up for your Forex Market Buzz with Greg Michalowski, Vice President of Trading and Liquidity at FXDD. I'm Remy Hoki. Join us later this afternoon for PM Exchange right here on ForexTV.com.